Mr. Page, thank you very much for your time to join Top Investors Talks. After the Fed meeting in June, many investors believe that the world has changed. In your second half 2022 outlook, you also call it a paradigm change. So what do you mean by that?
We're going from a long period of low inflation to an environment where inflation risk matters again. And the key question is, where is the Fed's so-called put? The Fed's dual mandate is to strive for maximum employment while maintaining price stability. But for the last 4 decades, there was no inflation risk, really. If you think about it, from 2000 to today, prices for TVs, computers, other electronics dropped by over 80%. So with no inflation risk in sight, every time we faced a growth shock, the Fed came to the rescue with rate cuts and asset purchases. Now there is true inflation risk, as evidenced by the headline print of 8.6% in the US. In this new paradigm, the Fed must choose between inflation or recession. That's what we mean by the paradigm shift.
Do you think the inflation in the United States has peaked or far from it?
I think it's close to have peaked. The problem is, even if it comes down, it might come down too slowly, or we might get stuck in the 4 or 5% range. And this creates problems because the Fed's long-term target is 2%. The key here is, of course, the demand side and the effect of rising and higher rates, which will reduce demand, and we're already seeing signs of it in different parts of the economy. However, we also have to look at the supply and the supply chains. There is pent-up supply in shipping, in goods, in labor, in commodities, in housing, in retail inventories. All this pent-up supply, once released, and it will be released at different paces depending on which parts of the economy, can help bring prices down, which should do part of the Fed's job in controlling inflation. That is the perhaps narrow path around which a soft landing is possible, but I'm not assigning a high probability of a soft landing.
This week, Jay Powell said before senators that the path is very, very narrow and that the recession is quite likely a possibility. How concerned are you about the recession in the United States?
I think the market is pricing a mild recession at best. I would say the probability of a recession, when I talk to our economists, between now and say the next 18 to 24 months in the US is at about 50%. And in Europe, it's higher. And our economists think that it's about 70 or 80%. Now, remember, sometimes, and more often than not, a recession ends up being a good time to buy stocks and buy credit and be a contrarian investor. So there will be opportunities to add to risk assets over the next few months, even if we get a recession. But those are my probabilities. They're not perfect. No one knows for sure. This is a tough time to invest and to try to take big positions in markets, which is why I said earlier, it's a good time to stay broadly diversified.
What do you think should the Fed do to navigate in this narrow path to achieve a soft landing?
So currently the Fed has not a lot of options, and it comes to the question of, do we want, or are we going to have an inflation problem or a growth problem? And when we talk about the narrow path for soft landing, it's just really, really narrow in between. Either we slow down growth too much, or we let inflation continue at a level that's uncomfortable. So the answer to your question is there aren't many options for the Fed except for pulling back on stimulus to try to bring inflation down. Again, in the background, as I mentioned earlier, we have to remember that supply matters quite a bit. And if we get more semiconductors on the market, if we get more commodities on the market, if we get goods moving again, if the cost of shipping goes down, that will help the Fed do the job. But again, there aren't that many options for the Fed or for any central bank in the world.
Why many investors believe that the world has changed? Because they cannot bet on the help from the central banks anymore. So generally, to the investors, where to park the money now and what is the play here?
Right now, we're slightly underweight stocks. We're long value stocks. We like bank loans. We've added to high yield bonds, which now globally give you over 9% in terms of yield. And we're also moving towards core equities, which are neither value nor growth. So this is playing defense, but in a sense, playing aggressive defense with the positions in the underlying portfolio.
We both know the 60-40 percentage allocation. Will that change in the future in this new paradigm?
Given the increased inflation risk, even if inflation comes down, it can still remain high, and the disappearance of the Fed put, I do think there's still a role for the 40% bonds. However, I would reduce it, and in some of our model portfolios, we'd put 12% of the 40% into absolute return alternative investments. That should lead to better diversification in this type of environment. Also, explicit downside protection strategies, what we call risk-managed equities strategies, have a more important role to play in portfolios going forward, and broadening the diversification, generally speaking, into higher alpha asset classes where you can use active management quite to your benefit, is also part of how we're rethinking portfolio construction.
The United States equity markets is finally in the bear territory. Historically, the bear market is long and painful, except the one in 2020. My question is, will this bear market be more like the one in 2020 or the rest of the history?
Yeah, that's a good question. Ultimately, it'll depend on whether we get a recession. Markets are pricing in higher rates, but they're not necessarily pricing a recession yet. Perhaps markets are pricing a mild recession. I have to say, history is not on our side. And let me give you some scary statistics, if you will. And I'm going to use US data here. Of the last 13 hiking cycles since World War II, 10 have ended in recessions. The Fed has never lowered inflation by 4% or more without triggering a recession. And here's a third scary statistic. There's never been a quarter in history, again using US data, with inflation above 4% and unemployment below 5% that wasn't followed by a recession within 2 years. Now, that's history. Currently, leverage is low in the economy, and usually before a recession, you have very high leverage. Consumers, corporate balance sheets, they're solid. Corporate margins seems to be holding up. The balance sheets are clean. And also, despite rock bottom consumer sentiment, people are still spending, and there's demand for services. So when we look at all of this, we remain invested in stocks, but we're slightly underweight stocks relative to our strategic target allocation. The key takeaway here is that in this environment, it really makes sense to stay diversified across the board.
So based on your research, can you tell me how long will this bear market go? 180 days or maybe longer?
I don't think it's productive to make predictions to the day of how long the bear market will last. I think you have to be realistic and be prepared to lean in. Usually, because we're contrarian, after a sell-off of this magnitude, we would be buying stocks. What's different this time is that we hold stocks. We hold a fair allocation to stocks, but we're not adding more. We're waiting for a few months to see how things develop. And again, the key question is, markets, especially in the US, have priced in higher rates and perhaps a mild recession. But there are risks to earnings and to growth, and that's why we're staying defensive.
We saw the sell-off of tech stocks brutal. Thomas Rowe Price Jr., the founder of your company, was called the father of growth investing. What is your take on that?
I think you need to invest in both value and growth stocks as part of a diversified approach. However, tactically, currently we lean towards value. So we've added a bit more of our portfolio into value stocks. To your question, if you go back and look at the last 10 years of data, growth is still in the 70th percentile of its valuation range relative to value, meaning 70% of the time over the last 10 years, growth has actually been cheaper relative to value than it is right now. The price-earnings ratio on growth stocks in the US right now is at about 21, which compares to 13 for value stocks. So even though we're playing generally defensive, generally diversified, we are tilting towards value. Again, I'm not saying you should not own growth stocks. I want to be very clear. But we are tilting towards value as a way to be contrarian, capture the valuation opportunity, and then get some exposure to manage risk around commodities, materials, exposure to financials, which we think should do okay over the next 6 to 18 months.
China has met a lot of growth headwinds this year, and many international investors are now questioning the growth, the investment prospect here in China. So T. Rowe Price is absolutely one of the leading asset managers in the world. What is your take on that?
Look, international investors are worried about the economic effects of the COVID measures in China, a slowdown in housing, and generally slower growth. However, inflation is less of a risk in China compared to the rest of the world, and China stocks appear cheap. They're down 34% in 1 year. I mentioned earlier we like to be contrarian. So if you take the perspective of a 12 to 18 month investment horizon, there's an opportunity to be contrarian again, to lean against the wind. We've already started to see a bounce in China stocks over the last few days. We're not sure about the timing and the nature of potential stimulus measures in China, but we think they are on the horizon. So there could be an opportunity.